Hello everyone. Welcome to today's session. Contracts often evolve. Changes in scope, pricing, or both may occur after the work begins. These changes are called contract modifications. And how do we account for them? Let's break it down in today's session. A contract modification is treated as a separate contract if the modification adds distinct goods or services and the price increase reflects the standalone selling price of those additions. For example, a contractor signs a deal to construct a shopping mall for rupees 500 crore. Halfway through, the client requests an additional multi level parking structure which was not in the original contract. The contractor agrees and prices the parking separately based on its standalone market rate. Since the parking facility is a distinct new addition and the price increase reflects the standalone selling price, this is treated as a separate contract under IFRS 15. A contract modification that is not treated as a separate contract is adjusted to the original contract depending on whether the remaining goods or services are distinct or not. If the remaining goods or services are distinct, then treat the modification as if the original contract has ended and a new one has started. And remaining transaction price, including the new modification amount, is allocated to the remaining goods or services. For example, a construction company signs a contract to build a 10-kilometer road for rupees 100 crores. After completing 4 kilometers, the client requests a change in the material, switching the remaining 6 kilometers from asphalt to concrete. This increases the contract price to rupees 150 crore. However, this increase isn't based on the typical rate for a concrete road but only an adjustment to the ongoing work. Now, this is not a separate contract because the project remains a 10-kilometer road, but only the material changes. Additionally, such change doesn't reflect the standalone prices of the modification. From an accounting perspective, the 6-kilometer remaining road are considered a new performance obligation distinct from the completed 4-kilometer road. The new transaction price would be 150 crores, that is the original 100 crores plus modification of 50 crores. Revenue for the completed 4 kilometers should be recognized based on the original contract terms. Transaction price allocated for the remaining 6 kilometers would be the unrecognized part of the original rupees 100 crore contract and the additional amount of 50 crores arising from the modification. If a contract modification does not add distinct goods or services, it is treated as a part of the existing contract rather than a new one. The total contract price is updated to include the modification and the adjustment is made to revenue immediately based on the progress already achieved. This ensures that the revenue reflects the updated price as the work continues. For example, a construction company signs a contract to build a 10-kilometer highway for rupees 100 crores. After completing 4 kilometers, the client requests a wider lane configuration for the remaining 6 kilometers but does not change the nature of the project. Here, since the modification does not introduce a new or a distinct obligation, the work remains part of the same highway construction project. Such modification is not treated as a separate contract. From an accounting perspective, this modification is adjusted as a part of an existing contract. The effect of changes in the price, if any, is recognized as a cumulative catch up adjustment, modifying revenue recognition for the remaining work. If the modification includes both distinct and non distinct goods or services, a mix of both approaches is applied. To wrap up, contract modifications can be treated in three ways. One, as if it's a new contract, if the modification adds distinct goods or services and the prices increase in line with your standalone selling prices. Two, as a termination of an existing contract and a creation of new one, if the remaining goods or services after modification are distinct from what was already delivered. And three, as an amendment to the existing contract if the modification does not add any distinct goods or services, in which case the price change is adjusted to revenue based on the progress already made. Understanding these treatments helps us to ensure that the revenue recognition is accurate. Thanks for watching. Drop in your comments below, and I will see you in the next video.